Or willing to invest in stocks. I think this is more useful and fruitful. Okay, let's go with that. So when we say stock markets, it's not just a New York Stock Exchange or NASDAQ. There are plenty of stock exchanges. We'll see that today. So today, at the end of the session, you should be good enough in knowing or differentiating a common stock and preferred stock. I think a checklist for you all. And how a stock is issued in the primary market, IPOs, we'll see that. What are the major stock exchanges or secondary stock markets? We'll look into it. And what's the process the trades take place in a stock exchange? And what are the market indices like S&P 500 and so on? Then who participates in the stock market? Is that the retail investors or institutional investors, or who are they? We'll see all that. Maybe US stock markets are the benchmarks for the world. They are the leaders. But why they are? In terms of market efficiency, we'll see how you define a market is efficient or inefficient. And we'll also have a look into international stock markets. This is what we have for the day. Okay. I think you're all aware of this. What is an equity, debt, bond, and so on. So we'll talk more about equity and equity markets today. Usually companies issue equity shares for the general public to raise capital for their long-term needs, usually to purchase assets or invest in projects. Then they issue equity instruments. So this is interesting. When you talk about equity instruments, it's not that equity shares. If you have looked into balance sheet, I think in the first or second session, where we looked into the balance sheet for some reasons. In the by the way, in the balance sheet, equity is a asset or liability. What do you think? Equity capital, you will see that in assets or liabilities. Sorry? Liability. It's a liability. Remember, owners are different from the firm. Firm is a different entity. Owners are different entities. So that way, firm is liable for the owners. You see them in equity. So within that, it's not that the shares that we are talking about many times, but it is also about reserves or retained earnings are part of equity. So this you call them as internal equity, and this you call it as external equity. So somewhere you find anywhere external equity, don't get confused. Those are the securities issued to the public. So they are, we know this, they're issued at face value, no maturity. And these are the probable returns you expect, either dividends or capital appreciation. There are some companies, they pay dividends irrespective of growth in their profits. Fixed dividend, you call or fixed rate of dividends actually. And capital appreciation, you don't find many companies paying dividends. For example, you take Microsoft, they didn't pay dividends for several years. So investors in that kind of companies will look only for capital appreciation. But there is a problem here. It's not a but. There is a tax on the whatever the return you have. You have dividend and you have capital gains tax. And the problem with the dividend is that the shareholders who can claim profits, they're already taxed by the company. Dividends you receive, they're also taxed. And capital gains you have if you sell the shares at profit, they're also taxed. So taxability is high. So SEC is the regulator taking care of this equity instruments. So when you look at equity instruments, common shares, which is known to everyone. In addition to that, you have preferential shares or preferred stocks. Okay. It's not that all companies issue preferred stock. There are some companies who issue preferred stocks to their employees or some known investors, something like that. They want them to be with the company. To hold them, they do issue preferential dividends. Then in the global scenario, you have depository receipts. We'll talk more about that, but quickly on that, foreign companies issue shares for American citizens. There will be a public issue of a company which is outside India, outside USA, maybe from India, UK, China, Japan, or any other country. They will be issuing shares here. That you call them as ADRs, depository receipts. You also have GDRs. We'll talk more about that later. Then in addition to that, convertibles and warrants are the instruments where they will be converted into shares. Right now, there are warrants or bonds or debentures, but in future, they'll be converted into shares. So why I listed all this is they all are taking the form of equity at the end. Even preferential shares can also be converted as common shares. So I think this you are aware of it. They have the important thing is they have the voting rights. Shareholders claim on the firm's profits. The managers work for shareholders. Remember, there is an agency problem where there arises a conflict between the manager and owner or shareholders. What's the conflict? Shareholders delegate the authority to take decisions to managers, and they are completely aware of out of the company's operations. Because of this, the managers may take undue advantage, taking care of their own perks or incentives, taking risky projects for whatever. They ride on the self benefits at the cost of shareholders' wealth. So why I'm trying to say that is, so shareholders' claim on profits will be hit, and the managers are working for their own needs. That you called as agency conflict or agency problem. So dividends are not promised; they are discretionary. Preferential shares, unlike common shares, dividend is fixed. Some give a maturity term, some may not give, and some also say that your preferential shares can be converted into common shares. I'm just rolling on. If you still have any question quickly, you can ask me. You can stop me. Now, stock markets. Let me show you. If you want to know about a stock, how do you do that? May I know from you? Did any one of you try, those who are holding the stocks? How many of you hold stocks? One? Only one? Two? Only two? That's a good number. Yeah, may I know, how do you search for your own stocks? How many stocks you hold? A rough
Well, I have an
ETF?
probably less than 10.
Less than 10. Okay. Maybe quick clarification. ETF is not a stock, but it operates as a share. Okay. So the reason here is mutual funds where they issue units to the public, they are also called as shares. That is a little confusion. So thanks for letting me know that. So, may I ask you, how do you search your stocks?
Either on Yahoo Finance or I use SoFi to invest. They have like a little bit of information.
Okay.
On stocks.
Okay. In general, as a student, as an investor, if you want to know information about the stock, Yahoo Finance is the best. Okay. It has an open source option. And if you want to have an advanced research, you can buy for that, subscribe for that. So quickly, may I know any of your stocks that you hold or you want to invest? Any one of you? No? Yeah, you're finance guys. Yeah. Sorry? What stock you would like to look at? You want to invest? It's crazy. It's interesting. It's potential for you.
One stock that I'm invested in, the stock ticker is FANG, FANG.
Oh, you know that.
Back.
Fantastic. Quickly on these stickers, if you have two letters, that is the oldest stock, oldest company. So number of letters are increasing means it's the younger company. Like FANG or NVIDIA, you will find four, means they are recent companies. So let's look at this. It is Diamond Back Energy. That's a company name. I hope you're aware of it, because to take care of our memory, we'll be more looking into the ticker. So when you look at this, this is days. Within a day, we have this. Okay. And if you want to have more, like this is for one day, what happened for 5 trading days, 1 week. Okay. This how it looks like. 1 month. This is how it is. This is consistently going up. It was 147 a month back, and it is 176. So $30 up closely. It's a good one. So 6 months, 1 year, and 5 years, it's all up to you. The price movement. Okay. And if you want to get more on this, so like statistics, you need to have, if you are taking investments as one of your courses, this will be more useful for you. But we are limiting ourselves to understanding the market as a whole. And I personally found something else. This is much interesting, right? To look as a market. Finvis. The beauty here is, can you see the screen is okay? Should I take off the lights? Is that fine to you all? Okay. So you can see those sectors. This is S&P 500 on the screen for you. And you have technology here. The size of this rectangle tells you that's the market leader in that industry. Like you have, if you take NVIDIA, I think that is the biggest company now, taken over all rest of all the companies, right? If you want to know more about it, you can get into it. This gives you a kind of a quick snapshot on what is what. This is technology. Google falls in communication services industry, and you have other industry, healthcare, financials, consumer defensive, and so on. This is interesting. Okay, coming back to our discussions. This is how the markets look like. They offer both primary and secondary markets. We'll see in detail. Then we have popular celebrity stock markets, New York Stock Exchange and NASDAQ. New York Stock Exchange is one of the oldest, not the oldest. And NASDAQ is very young. It is the one which brought technology. Regulator is SEC, Securities Exchange Commission. And it is known for wealth creation because it provides you all the opportunities to invest, trade, hedging, speculation, whatever you want. And it is also in index of economic prosperity, like along with other economic factors like GDP, employment rate, and so on. And when you look at market efficiency, this is too early. I gave you the slide, but I will repeat once we finish this topic. When you look at markets efficiency, Eugene Fama in his research, Nobel laureate, gave a forms of market efficiency, where he says straight away you cannot say a market is efficient and the other market is inefficient. No, you can divide them into three different forms: weak form of efficiency, semi-strong form of efficiency, and strong form of efficiency. What do you mean by that? In weak form of efficiency, what it says is all the historic prices, that related information is already discounted, and historic prices will not help you to forecast future prices. So technical analysis is of no use for you. Okay, so that's what a weak form of market tells you. Most of the tests said that yes, weak form of markets exist. Means technical analysis cannot be of any use because all the publicly available information historically is discounted. Prices reflected that. And semi-strong form of efficiency, this talks about fundamental analysis. Those who have taken investments as a course, this is more relevant to you. So it says even if you try to do fundamental analysis and try to get abnormal returns, you can't do it. Why? Because the market is in semi-strong form of efficiency. So what do you mean by that? A company announces a new project in the morning. So immediately the whole market reacts and accordingly the price goes up to that extent. Next day, you can't find any change in that stock price based on this information, public information. So that's what you mean by semi-strong form of efficiency. Then strong form of efficiency, this talks about insider trading. Private people in the company, they have the information in hand, like companies making losses, which is not known to the public. They try to sell their own shares which they are holding. That's insider trading, which is an offense actually, but still there are methods for that. Okay, Fair Disclosure Act and so on. But still, if you say some market is strong, has strong form of efficiency, then it should reflect even the private information also. But most of the empirical tests showed that strong form of efficiency doesn't exist. Okay, so weak form and semi-strong form, these two exist. Strong form doesn't exist. Okay. There are some methods for that to overcome that. So when you look at regulators, you have SEC, most popular and known. These are the acts related to that. And SOX to 2002 is one more thing which got some flexibility. And SROs, like stock exchanges, big financial institutions or big financial companies, they get the status of SROs as they're too big in terms of operating number of people or operations, trades, or whatever. SEC delegates some responsibilities to these institutions so that they will frame their own guidelines, rules, and regulations, and they direct their participants. That you call them as, like New York Stock Exchange is an SRO, NASDAQ is an SRO. Then I think Financial Regulatory Authority, FINRA, it is more famous is. I think there are more FINRA certifications. All finance students, I suggest you go through those certifications and try to complete one or two based on your interest related to stock exchange or real estate or depository or operations, whatever. That helps a lot for your career. Now, that is in general about the markets. Now, let us be specific. What I did is I divided the whole discussion into primary markets and secondary markets. Let's start with primary markets. So we have been talking about this. Primary markets are the markets where new shares are issued. Okay. I have been participating with that in the earlier classes very well. They add shares to the company, new shares are added. And new capital may not be added. That depends on what type of issue is that. New capital is added means company is raising for additional capital to fund its capital. New capital is not added to the company means existing shareholders are selling their shares to the public. That can also be a primary market issue. So process is not just simple. It has to go through SEC filings. Red herring prospectus has to be prepared and approved by SEC. Then these are the broad reasons I put reasons to raise capital, new projects, expansion, R&D, automation, equity dilution, and debt reduction. Debt reduction is the company wants to cut down its capital structure, leverage. It is relying on high leverage, high risk. So maybe credit rating is getting affected because of that. So they want to cut it down. So they want to retire the debt with equity. Okay. So within this, you can classify the issues in primary market as public issues, IPOs. A company is offering the shares for the first time. Then SEO, a company is offering the shares, but not for the first time, second time or third time or whatever. Direct public offers, they directly offer to the public without any intermediaries, investment bankers or underwriters. Then there is something very different, which is known as SPAC, special purpose acquisition companies. They don't do business. Then what do? They pull up money from the public, they set it aside and invest in a company where they are acquiring, just acquisition. For the sake of buying or acquiring a company, they mobilize the funds from the public, which you call them as SPAC. Okay. Once the company acquires the another company, the SPAC gets diluted. All this shares or capital goes to the acquired company. That's what you mean by SPAC. In addition to that, in primary market, you also have a rights issue where existing shareholders will be invited to participate, and private placements where only selected mutual funds or institutional investors or foreign institutional investors are offered to take the shares. Then direct issues, only one institutional investor. Direct listing, maybe it happens with the class B shares of a company where they directly list in the stock exchange. Then hybrid issues, convertibles and warrants, I already discussed on that. So who will be issuing? It is more about corporations, right? In addition to that, SPACs, just now I told you, like FINIMA, Freddie Mac kind of federal sponsored or government related, they can also issue. Then there are investment companies like mutual funds and others. They can also they're more known as RICs. So when you talk about federal government, these are the bodies. I think we discussed about them when you're talking about mortgages, FINIMA, Freddie Mac, Genema, and so on. They also issue shares. And this is a quick summary of regulated investment companies. I think these are kind of mutual funds, REITs, real estate investment trusts, exchange traded funds, as you're talking about, open-ended funds, where we can invest anytime and you can come out of any time. Closed-ended funds that offers only for one time. Okay, you cannot buy and come out of it again and again. Then business development corporations, and you also have SPACs. So to have a quick understanding of public issue of shares, remember this can also apply for public issue of debentures and bonds also, but you're talking about only shares. So if that is the case, you have issuing corporation, the companies, issuing to investors. In between, there lies investment bank. So can you tell me why companies go for the help of intermediaries like underwriters or investment banks? Why can't they issue shares directly to the public? For example, and I told you here, this is direct issues where target investors are there. You also have private placement. When you have these opportunities, why should company rely on intermediaries? What do you say? Did you get my question? Companies offer shares to the public, but they rely on investment banks to sell their shares to public. Why is that? What could be the reason? What do you think? Yeah.
Maybe it takes away the liability on the company to issue all the shares.
They don't have any liability at all. It is between the investor and the issuer. They're just the intermediaries. I hope I clarified.
Yeah.
Very good. I got it straight away. So any other question or guess related to this?
I have another question. Don't they take on liability if it's firm commitment,
Intermediaries?
the investment bank?
Oh, I'm sorry. Okay, I thought you're talking about the liability as a security. Oh, I think you're right. What you said is right. Maybe, okay, liability is a too tough or harsh a word. Yeah, I think both of you gave the same answer. For example, we talk about underwriters. Companies pay 5%, 8%. The study shows, most of the studies showed that it is approximately 8%. Underwriters take 8% of the issue. What does it mean? Which means that if the company cannot get the capital from the public to the full in the sense 90%. Anything less than 90% is not full. So 90%, anything less than 90%, underwriter is liable. You're right. Okay. He is supposed to pay the gap. For example, I'm raising $10 million from the public. I got only 9 million. It is a success. It is a properly subscribed issue. That's not a problem. But how about if I get only 8 million? The rest of the 1 million has to be taken care by the underwriter. That is the risk he is taking. He's perfectly right. You got it? So it's not that easy. Talking in the classroom, giving the exam and writing, doing our own research, we can do sitting at our own desk. That's nice. But into the reality, raising the money from the public, it all depends on many factors. And it is more tough for new company. If Apple comes for public issue, they don't go for underwriters. Nvidia come for public issue, they don't, right? They can directly offer, but there are some little activities, filing a prospectus and so on. Still they go for. But when you look at underwriters, all the companies, they don't go for underwriting. So that makes company depend on investment banks for the process and underwriters to guarantee the liability. Okay. So I think I mentioned here, there is always, because of this dependency on investment banks, there is always a cost of 10% approximately. They call it as winner's curse, which is a cost on the head of the firm to issue shares. So what do you mean by underpricing here? I price my stock for say $100, for example. And when it got listed in the stock markets, on first trading day, it got traded for $120. It means my stock is worth of 120, but I offered only for 100, right? Why? Because underwriting charges. The cost is involved, the company is losing there. Sometimes, depending on the issue size, there could be more underwriters where you can call them as syndicates. Then, if you look at stock registration, investment banks take care of this registration process where all the IPOs rely on investment banks. And it starts from registration with SEC, filing the RHP. If all okay, it is done. If not, SEC may ask for more information. Then if it says okay, then official prospectus is issued by the company to the public, then shares are offered. This is the whole process. These are all taken care by investment banks. You also have shelf registration. I think I have a slide for that. Yeah. So shelf registration is kind of a process. It is similar to red herring prospectus, but they want that to be flexible. They finish everything, but they don't give the dates. Okay. So maybe they are waiting for the market timing. Market is okay, and they're expecting the market to come down. So once it comes down, they try to change the price and announce the dates. Not only that, there are some firms where they frequently offer shares once in a year, once in 2 years or 3 years, something like that. Okay. So some examples for you. McGraw-Hill, the Connect you are using, McGraw-Hill has come for public issue. And what's the reason? It wants to reduce its debt, and it also wants to pump more money on its EdTech. Connect is part of that. There is one more company, Miami International Holdings. It came for more for business operations and future growth. And one more company came for hard flow, public issue hard flow. The purpose is market expansion. So different goals, different motives. So that was more about primary markets. Any quick question that is missing, you can ask me. Okay. Secondary markets. More than primary markets, secondary markets are more popular. They are the celebrity markets, we can say, because the prices are random. In primary market, price is only fixed. By the way, I think you didn't ask me. There is a method of fixing the price I didn't mention here. When the company offers shares for the public, it can say straight away $100, for example, I'm saying. And the other way is dynamic pricing, where it is done on book building. Book building is the process where price is discovered from the public through auctions. They will give a range, say $80 to $120. They give a range and they accept the bids from the public. Okay. Whatever the price was offered by many participants, that will be fixed for everyone. Okay. And there is also a method called auction. Highest price will be given first because they're selling the stock. That is also a method. Okay. So this is an interesting study which showed that households are the leading investors in stock markets, secondary markets. They hold shares. Households means retail investors like you and me, everyone. So they directly own 41.5%, and they also indirectly invest in mutual funds. Either way, if you are not good in, you don't have time to study the stocks which I was trying to show in Yahoo Finance or Finvix, then you can rely on portfolio managers who are professionals working for a mutual fund. And mutual funds are 20%, foreign investors 17.5. You might be wondering, when we add all these three, it is not 100%. The reason here is there is a repetition of this mutual fund here as well as here. Okay. So when you're talking about trading in stocks, you may have stocks which are listed and there are stocks which are not listed. Okay. So stocks listed, we all know, listed in the stock markets. You can categorize them as large cap stocks, medium cap stocks, or small cap stocks. They're also known as mid cap stocks. Shares you have class A, class B, class C. Like Warren Buffett, he held a major chunk of the stocks by himself with a different class, and its face value, one share was trading at millions of dollars. Okay, the highest price stock was Berkshire Hathaway. The reason here is he doesn't want public to be into his company. He didn't want to have that. So that's how it happened. It is not restricted, it is listed, but he didn't split the stock. Later, he went for stock split. Then restricted shares, they're invested to some in the public issue, importantly for investors, but they're restricted. Shares through private placement, they are not traded actively because they're not listed. Same is the case with private company shares held by the company itself and Class B shares, where the promoters or founders hold that. Now, this is very important classification. I think most of the books doesn't teach you. You will not find this in your books also. You have some info on ECNs, but categorization is very important. When you look at secondary markets, we all know about stock exchanges. Okay. And moreover, we know only about national stock exchanges, but we are not aware of regional stock exchanges. I think I have a list for that. I will show you. What I'm trying to say here is national stock exchanges have more stocks listed, more active trades, more liquidity. That's the reason we all look at national stock exchanges, but not regional stock exchanges. That is number one. And we also have OTC markets where shares are traded between institutions in their own platforms. Okay, that we called as OTC markets. In addition to that, this is very interesting. We'll talk more on ECNs, alternative trading systems, alternative to stock exchanges and OTC. You have ATS, which are ECNs and non-ECNs. ECNs are electronic communication networks. I think before NASDAQ, electronic communication networks or ECNs are quite active. Maybe that inspired NASDAQ to have a full-fledged, fully electronic trading system. Now, from secondary markets, now we have narrowed to stock exchanges only. Okay, so when I say stock exchanges, we are talking only about these kind of exchanges, not this. So the beauty of exchanges is that they have all varieties of participants: retail, institutional, governments, domestic, national, international, foreign, everyone. You have brokers, dealers. The beauty of the stock exchange is price discovery is too good. Okay. So, but all depends on demand and supply, and the bid-ask spreads are too narrow, unlike other exchanges, other markets, sorry. The cost is low. I think thanks to technology, thanks to NASDAQ, once the electronic trading platform ignited, I think costs came down drastically. I think those who want to operate on trading account to buy shares, you will see that brokers are not offering you any commission or brokerage. Why? The reason here is it is not just the brokerage as a commission charged on you. They also make money between the bid-ask spreads that they gain by managing your orders. Okay. So transaction, when I say transaction cost, it includes the commission or the brokerage and the bid-ask spreads. Then the super liquidity with price continuity. Of course, markets are closed. 9:30 to 4 p.m. is the market, but still there is a price continuity till the next day. I think there are plans to make the price continuity 24 hours, including the weekends. Maybe that day will come. One more beauty of this is reduced information costs. If you want to know about your own stock, your own portfolio, your own broker will give you a lot of information. And just now we have seen on Yahoo Finance, Finviz, you go to SEC, you go to New York Stock Exchange website, open sources, free data is available to you all. So again, specifically about New York Stock Exchange, among the national stock exchanges, I think the whole world tracks New York Stock Exchange. Okay, it is one of the oldest, started in 18th century, and Nasdaq, it started in 1971, and New York Stock Exchange NYSE ARCA is more for ETFs than all stocks. NYSE ARCA and fully electronic. New York Stock Exchange is not, you'll be surprised to know that still the floor trading happens. There will be an open outcry. I don't know how many of you have seen that. In the olden days, when I was young, like you, I was participating in the trades, and the trades used to happen. People shout a lot. For example, there is Apple. There's some quote given. The symbol is they look for Apple. Someone should see you, Apple, 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 like this. And they will track you, they say. Then you guys come closer. Then there is a price given there, say $100. And I say 10 cents up, 10 cents up. Maybe they break they have some gestures, right? There are symbols actually. They operate on symbols in the open outcry. Now you not worry about it. Everything is electronic. So, but even now in New York Stock Exchange, floor trading is there. It's not that kind of open cry in the olden days, but still they use technology for that. But still floor trading is happening in New York Stock Exchange. Since its inception, NASDAQ is fully electronic. So that's how NASDAQ and NYSE ARCA started. And this is interesting. Regional stock exchanges, maybe many of you are not heard about this, but I thought I will share a list of this. These are all the regional stock exchanges in our Florida state. Miami International Securities Exchange, it started in 2013. And you'll be surprised to know the oldest stock exchange is not New York Stock Exchange, but it is Philadelphia Stock Exchange, which started in 1790. So some important facts on New York Stock Exchange. It is an LLC now. You call it as New York Stock Exchange LLC. You'll be wondering, such a big stock exchange, it's not a corporation. The reason here was, I think I mentioned somewhere here, it was a kind of demutualized. It was a mutualized organization where New York Stock Exchange was started by few members, and all the members own that. Okay. Then in 2006, they demutualized it, which means they came out of that mutualized non-profit organization and made it as a company or business entity, but with a LLC. Then ICE took over New York Stock Exchange, Intercontinental Exchange. That is the body which owns. That's a company which owns ICE. It's an American company, owns New York Stock Exchange right now. So flow trading or any trading, it happens with the DMM. Please remember this. Earlier it was known as specialist. Now it is known as designated market maker. I think this is followed by other markets also, but New York Stock Exchange follows this. They have a specific trading post here. I think I put this for you here. So information is displayed on the screens. Okay. Then you have a ticker display here. Then this is the the trade station. The person attending this is the DMM, and you have brokers and dealers communicating and finally dealing with this DMM. That's how it still happens in New York Stock Exchange. So, did you understand designated market maker? Like in the public issues, underwriters take care of the guarantee of the issue success. DMMs, they don't guarantee, they don't have the liability, but they ensure liquidity, transparency, and proper fair functioning of the stock markets. There's no market rigging or insider trading. They protect all of us from insiders who have insider information. Okay. So as they do it, they have different types of orders. The customer orders, where they trade for public, and they also have the trade for their own account. The beauty of DMMs is they take the responsibility to ensure liquidity and fairness of the trade, but at what cost? They buy if they feel a stock's price is going down for no reason. They put their own money and buy that. And and if they feel the stock is getting sold at overprice, they sell stocks from their own inventory. No one will help them. So that when that happens, they trade from their own accounts. There are something called limit orders. Nominal order is when you look at orders, there are two types of orders: market order, limit order. Market order means you have the best price to sell, best price to buy. These two you have. Okay. Did we see that anywhere? Let me show you that. Like let's see Apple. Do I have the bid ask? Okay. So don't have if we have the personal trading account, I think I can't access it right here. The close is 264.35 is Apple's trade price. If you want to buy, you will see a different screen with the list of buyers and list of sellers. Okay. List of buyers will be trying to buy for the lowest cost. List of sellers, they will be willing to sell at highest price. So a match between these two trade happens. Okay. For example, sellers, buyers. Okay. Seller says 265. Buyer is asking for 264. This is the best bid. This is the best ask. So again, you have one more buyer for 264. Sorry, 263.50 and 263 and 262.75, something like this. This is the order. Okay. And you have the best seller for 265 and you have for 266, then 266.50. If you open your trading screen, you will find the same order. What did you understand this bid and ask? The lowest among the sellers will be the best ask. Okay. Highest among the buyers will be the best bid. Okay. And the difference between these two, you call it as bid ask spread. What's the difference? This minus this. I'm just giving you just like this. On screen, it may not be like this. So higher the spread, low is the liquidity. Low is the spread, high is the liquidity. Okay. The best markets in national stock exchanges like New York Stock Exchange and NASDAQ, you will find narrow spreads. In regional stock exchanges, you try to find maybe spreads are too high, liquidity problem. Okay. So, so the trade may happen between these two. Maybe he increases his price to 264.50 and he cuts down further to 264.50. Then trade happens. That's how the trade happens. So all these are done electronically. In the olden days, open outcry, everything is electronic now. So you can also see how many orders are there here and how many orders are there here. Say here there are 100,000 and say here there are only 1,000. What do you infer from this? These are the total buy orders. Buy outstanding share willing to buy. Outstanding orders willing to sell.
Maybe a lot more.
As simple as that. So this can also give an indication that price may go up. Okay. So it may not be guaranteed, because that's the reason I was why I came to here is where is it? I was talking about limit order and market order. When you look at, if you want to buy immediately, give your price for this, you get the shares. If you want to sell the shares immediately, enter your order with this. It will be sold in a fraction of a second. This is what you call as market order. But there are some orders called limit orders. What do you mean by that? For example, you put the price as 262, or you put the price at 265. What is the best buy? 264, right? Can you please all of you look at the board once? The best bid, the best buy price is 265 because it was the highest. But in limit order, I put an order in such a way that if the price goes to 266, you should buy. It is a limit order, remember, which means if these trades reach to 266, last trade price reaches 266, I will buy. If it is a normal order, for example, I am putting 266 here, my price becomes the best price. In the limit order, mine is not the best price, it is hidden, it's a kind of hidden. Why I'm trying to say that here is, there could be more limit orders also. They all are not the market orders. That's the basic difference. Okay, so that's how you can play with the numbers on the market. Then switching to NASDAQ, I think historically first fully electronic stock exchange. They also have market makers, but unlike New York Stock Exchange, where there is a designated market maker for every company's stock, here it's not like that. There are more. For one company, there could be more. And on an average of 14, there are 14 market makers for every stock. They clearly classify as small cap, mid cap, and large cap. I think with the intention of making more profits for the short term or within the day, remember, number of trades which happen in an exchange does not mean that all are buying and holding or investing. No. There are many traders in that. Maybe 80 to 90% are trades. They buy in the morning, sell by evening before the market closes, or sell in the morning, which you call a short selling, sell in the morning and buy in the evening before the market closes. They are known as traders or speculators. There are arbitragers also. If there is any price difference between New York Stock Exchange and NASDAQ, for example, they buy here, they sell there. Apple is 266 in NASDAQ. Apple is New York Stock Exchange, it is 264. $2 difference. So they sell in NASDAQ, buy in New York Stock Exchange. Usually there is no scope for that with this electronic trading and informational transparency, but still I'm just giving an example. That you call as arbitrage. Then people also go with algorithmic. I'm sorry, I missed this. There is something called program trading, where index funds will be using more to increase their profits for their unit holders. They'll be buying a huge amounts, at least a $1 million of funds um, to buy or sell or do both simultaneously with 15 different stocks minimum. But that leads to volatility. There is no new information, but only because of the portfolio or investment strategies, the index may become little volatile. Algorithmic trading can be done by anyone if you have your own strategy, that if technology index is going up by 1%, buy Apple stocks, buy Nvidia stocks to an extent of this amount, this percentage. That is algo trading. They'll look for momentum or investment strategies. It depends. So to take care of all these things, we have exchange level restrictions. If market is too volatile, market freezes. No trading. Trading stops for a while. Trading stops for 15 minutes. Based on SEC regulations, I think it happened in the COVID panic situation. Markets halted for 15 minutes for many days. I think I got some dates also on March 9th, 12th, 16th, and 18th, 4 days. Market halted for drastic fall, crash. It crashed to 7%. Then market halted for 15%. And the race restarted after 15 minutes. I think these are some of the stocks where you can look into. If you're looking at a stock, you can get all the information, primary information here. This is the last traded price, traded at, percentage change, up or down, minus or plus, and percentage change, up or down. And look at the volume. This is the list of hot stocks. Why they're hot? Because look at the volume, 415 million stocks are traded, and close to 19% up on the day. Okay, and this is the 52 weeks period. So you will find something interesting. Traders, speculators, they keep a close watch on this. I think you don't have to calculate anything, but I'm just reminding you, when you're talking about markets, you should be knowing returns. We have done earlier on this. We finished this. When you're calculating yield, you have current yield, holding period yield, total yield. Total yield is about dividend as well as capital gains. Holding period means compared with a purchase price. Current yield is with current market price. I think this is interesting. Alternative trading systems. So I'm saying alternative trading systems. They are the alternatives for what? Any guess? Alternative trading systems are the alternatives for? You're right. You're absolutely right. But my question is, they're the alternative for whom? The main stock exchanges which we have been talking about, New York Stock Exchange, NASDAQ, and so on. We also have alternative trading system. They use technology, electronic, and everything, right? They're alternative to them. So one of the popular or famous ATS are ECNs, electronic communication networks. So other non-ECNs, which are ATS, are dark pools, crossing networks, call markets, single dealer platforms. We'll be talking more about ECNs. So they are electronic computerized systems operated by broker dealers. Not all brokers, broker dealers, which are big financial institutions, they only can do it. So important features of this is that there is no primary listing. They trade the shares which are already listed in big exchanges, national or regional exchanges. They have the extended hours, as our friend rightly said, before trade or after trade. That's an opportunity, to be frank, because I want to buy or sell, but market is closed. ECNs are there, they're open. You can go for that. And spreads are so tight. Okay, efficient markets have narrow spreads. ECNs have very tight spreads, maybe a sub penny kind of. Then liquidity, it is okay, not bad. Then I think fast execution, anonymous trading, transparent, these are common to the mainstream national or regional stock exchanges. And these are different from national or regional stock exchanges. Okay. So I just listed some of the popular ECNs. Can go through it if you want to know more about it. What is interesting is the timings, post-market sessions, 4 p.m. to 8 p.m. Then markets are up, markets are down, markets are crashing, markets are booming. How do we know that? How are we saying that? We look at indices. Based on that, we say that. So when you look at indices, you have market value weighted index. Higher the market capitalization, or what is market capitalization? Any guess? What is the market cap? Market cap is the price of the stock times its number of shares outstanding. That gives you the total value of that company. That's what you call as market cap. So you have large cap stocks, mid cap stocks, small cap stocks. That tells you how big the company or how small the company is. So indices, most of the indices, not only in US, across the world, are value weighted indices. And you also have equally weighted indices, DJIA. Then you also have fundamental weighted indices, variety of indices, but popular ones are S&P 500, NASDAQ Composite, which are market value weighted indices. These are popular. And in addition to US indices, you also have actually all these indices, they follow American indices, S&P 500 or S&P 500 usually. Okay, but still I just listed major stock exchanges, which are much bigger after US stock markets. So I think with increased foreign investments and so on, and active euro dollar, which was more popular and made UK European stock markets a bit active, there is a global integrity among the global stock exchanges, because even exchange risk can be diversified in terms of political unrest or foreign exchange rate fluctuation and so on. Then interesting numbers here. 1990, I think US had close to 35% of the trades in all the stock markets, followed by Japan. And in contrast, if you look at the latest, still US is the dominant at 42%. No one is close to that. Followed by Europe. Sorry, it's not Europe. You can see here, it is Japan alone and Europe. And they used to call it as triad. US, Europe, and Japan. That's a big trade. These are the three big trade partners. But now picture has changed. You can see here, US followed by Asia Pacific and Europe. Things have changed a lot in these decades. In addition to the domestic issues I was talking about, foreign companies will be issuing shares for American investors. So we have three levels of ADRs, level 1, level 2, and level 3. Level 3 is the biggest one, which has this almost a status of American company. In terms of stock exchanges, you see New York Stock Exchange here, and you see Philadelphia Stock Exchange here. But before that, there are stock exchanges in London and Amsterdam, which probably these are first kind of exchange in the whole world historically, which is originated from as Dutch East India Company with their colonial rule, whatever the money they had, they focused on their own country and boomed the economy. And there was a lot of wealth creation with financial transactions. Largest stock exchange, I think the American stock exchanges are on the top and followed by China, Japan, India, Hong Kong, China, London, Saudi, and Euronext. I think lastly, this is something interesting. What is the impact of exchange rates on their own respective indices returns? This is a very interesting study here. So you can see this is a change in terms of local currency, change in terms of I'm not getting US dollar. There is a difference here. Okay, look at this. Brazilian indices are positively related. Brazil, India, and Argentina. They are positively related to the exchange rate movement. Exchange rate goes up, index is also going up. That's what you mean by positive. And other Canada, China, Euro, and Japan and South Africa, they had negative. Means exchange rate is going up, stock returns are coming down. That tells you a lot. And when you compare the same with the US dollar instead of their own currency, I think things have changed to some. Yeah, I think except India, it is the same. This is something interesting. When you take in Indian rupee, it was positively associated. But if you have taken US dollar denomination, it is negative. Okay, so this speaks about global exchange integrity influenced by exchange rates between the countries. Okay, I think this is all about a global scenario. So going back, this is what we have covered. Still, if you have a question, you can ask me. Differentiating the stocks, differentiating exchanges, issuing shares to the public in IPOs, ECNs, global markets. If you have any question, you can ask me.
I do have a
Yeah,
question.
please.
Like right now in the stock market, the market cap of the companies are way higher than the intrinsic value. Do you think like they're gonna correct the prices eventually?
That's what market efficiency is all about. We discussed about forms of efficiency. If there is a continual studies, even studies on in US stock markets, and they continue to prove that yes, we have weak form of efficiency and semi-strong form of efficiency. But maybe answering your question, there could be some intrinsic value is different from the market price. Maybe insider trading is there, but that is not a long last. That will be for a few days or maybe a week or two, not more than that, for sure. Any other question? I think that you will learn more in your investments. You've taken already or yet to take?
No.
Okay. Anything else? Okay. If you have no other question, let me stop here. Thank you all for your wonderful participation. See you in the next week.